Hello everyone and welcome back to TradeSmart. Today we are taking a look at one of your strategy requests, but before that make sure to like, subscribe for future trading testing videos and make sure to comment down below if you have any questions or trading ideas, as I can still answer all of your comments. This strategy is going to be a 5-minute double EMA plus MACD strategy with trailing stop loss. So what is a trailing stop loss? Basically, when you enter into a trade, you set a fixed stop loss, but as the trade starts to go into our predicted direction, we move the stop loss closer to our break-even point and then even into the profitable area. Let me show you an example. Here is an example how you can use your 20 exponential moving average as your trailing stop loss. So let's say you entered into a short position on the MACD cross down. Normally, you would set a position like this. We are targeting 1.5 to 1 risk to reward ratio. Instead of using this risk, after we reach that 1.5, we can move our stop loss following the EMA until the price crosses back up above the EMA. So in this case, you will be still in the position until this point. Because on this candle, we closed above our EMA. So you would have made around 2.8 instead of 1.5. And that is pretty much how you use a trailing stop loss. And why it is good? With using a stop loss, you can ride the strong moves of the market without closing positions too early. With that said, let's get into the strategy. Okay, so for this strategy, we are going to use two exponential moving averages and the MACD. So let's type in exponential moving average and click it 2 times. Now type in MACD and click it once. First, we are going to set both of the EMAs to a different settings. So go into the first one and set it to 50. Go to style and color it as you like. I will color mine white. Click OK. Go to the second one and set it as you like. I will set it to green. And for the length, we are going to use 100. So you have a 50 and the 100 EMA. We are going to leave the MACD settings as it is. And now let's look for a long position. For a long position, you will need the price to go above both of the EMAs with at least 10 pips. So what is a pip? A pip is basically the lowest percentage point that stock, a commodity, or in this case the Euro-USD pair can make. How do we measure it? We can use this measurement tool, or a better way is using this date and price range. So click on that and see when the price crosses above both of the EMAs. We have one cross up right here. Let's measure the 10 pips. Here you can see we have reached 10 pips, but the price haven't reached that point. So it's not going to be an entry. Let's go on and see another one. Here are 10 pips. This candle didn't reach it, but if we move it, we can see that the candle after that reached 10 pips, right around here. Now, if you have a candle that reached 10 pips, crossing above both of the EMAs, we need to see if we have a MACD cross in the last 5 candles or not. I will drop down this line here, and we are going to count back 5 candles. So 1, 2, 3, 4, and 5. And as you can see, this 5th candle was a cross up, so it's going to be a valid entry. Now let's set a long position. You are going to move the stop loss to the last pullback, which is around here. And you are going to target 2 times the risk, right around there. As you can see, first we hit our stop loss, so it's going to be a loser. Now let's look at another entry. So you have the MACD crossing down on this candle, and right after that we have the MACD cross up again. We have the price at least 10 pips above. In this case, you will need to wait for the candle to close, because this is the candle which makes the MACD cross up. So you don't really know if it's going to be a MACD cross up or it's going to close below. And because of that, you can only take trade at the next candle's open. So let's put an open position right there. Let's target the last pullback and target 1 to 2 risk to reward ratio, which is going to be right around here. And as you can see, it hit the first take profit. Now what you need to do is close off half of the position and leave the rest riding. So to see it clearer, I will put another position right here. We are going to move the stop loss to break even. And we are going to look if the price has moved under the moving average with at least 10 pips. So we grab our tool again and see where we reach 10 pip, and we reached 10 pip right here. So once the price reached the 10 pip, you are going to close off all of the position. So we'll move this take profit right there, around here. So basically that's a long entry. Now let's see a short example. As you can see here, we have the price crossing down under both of the EMAs. Now we will see if we have 10 pips. 10 pips is right around there, which means on this candle we get an entry. So for an entry, you will need to see the MACD cross down within the last 5 candles. So let's count back 5. 1, 2, 3, 4, 5. And as you can see, we didn't have any MACD crosses down last 5 candles, so it's not going to be a valid entry. Let's go and move on to the next one. For the next one, we will need to wait for a MACD cross up and then a cross down. We don't have any cross downs. We have a cross down right here, but the price is between the two EMAs. So we are going to wait for the price to go under both of the EMAs. Now here you can see on this candle we are moving under both of the EMAs. Let's check where are the 10 pips. It's going to be right around there. So here we reached 10 pips, and now we are going to look on the MACD, count back 5, 1, 2, 3, 4, 5, and you can see we didn't have to count back 5. We had a MACD cross down right here. So this is going to be a valid entry. Let's put a short position right there. Let's move your risk to the last pullback, which is going to be right here. And you are targeting 2 times the risk. Right there. As you can see, it's going to be a loser again. This is a bit more complex strategy. I hope you still could understand it. If not, play back the backtesting phase on 0.25 speed, and you can see all of my positions and how I took them and closed them. Don't worry, it's going to be very clear. And now, let's get right into the 100 backtests. And the results are in. After 100 trades on the Euro-USD pair on the 5-minute time frame with a variable risk to reward ratio, we got 36 winners and 64 losers, which gives us a gain on the account of 10.82%. With a 1 to 2 fixed risk to reward ratio, we would get 8% gain on the account. That confirms that using a trailing stop loss in this case has worked out. Most losers in a row was 8 and most winners in a row was 5. Time to complete the 100 trades was 35.5 days. This strategy is not bad, but it has to go through a lot of optimization to be reliable. As you can see on the account balance growth diagram, it has some serious pullbacks which we don't really like in a strategy. This is one of those strategies that have big losing streaks and a few winners in a row. which means this strategy is ideal for my variable risk-taking optimization. Let me show you the account growth chart with applying that optimization rule. As you can see, it did way better. With 26% gain on the account, it almost tripled our profits. If you want to learn more about this risk-taking optimization, check out the link popping up in the upper right corner right now, or the video link in the description. Just before you go, I wanted to say thank you for watching, and make sure to watch the next strategy backtesting video, because that strategy has some potential in it, and we are going to optimize it and backtest more later on in this YouTube channel. If you find my videos valuable, drop a like down below, subscribe, hit the notification bell to get notified when I upload the next strategy backtesting video. If you have any questions or trading strategies or tips, make sure to drop a comment down below, and see you in the next video.